What return over the long term can you expect if you invest in Apple right now? And with this, welcome back to Investing for Generations, your channel for high quality stock research for long-term value investor. And first of all, I want to say thank you to my first 350 subscribers we just reached yesterday. And when I started this project, I never expected to ever get 350 subscribers because I really thought nobody's interested if a random German guy talks in bad English to an audience. Of course, all of the channel, first and foremost, is just for my daughter, for education reasons, that she just can figure out how to invest in stocks when she's old enough for that, and also can understand how her father built a little bit of wealth for her. And so this is the main reason for the channel, and that so many people just stick with me and watch my videos is just amazing and exciting. And so if you want to join this group of people, of long-term value investors, just click the like button, subscribe to the channel, and ring the notification bell to never miss another video, and let us go this way together in this journey together. A big thank you for all of you, and I'm really overwhelmed. So today I want to talk about the expected rate of return when you invest in a maybe great business but in an overvalued stock. And of course, lately the S&P 500 and the whole market is driven by the tech sector, by the FANG stocks. And I want to show you on the example of Apple, how much can you expect if you invest in a stock like this right now. Because of course, all of these companies are great businesses and will be for a long time. But as I told you in all of my other videos, no business is good enough to buy it for overpriced price. And I try to explain in this video what you can expect if you even buy it now over the long term. Just if you don't know, I made a deeper analysis of all of these businesses. You find this on my playlist on my channel. Check this out, and there I calculated also the intrinsic value and just give you an impression when it's time to buy, at least in my view. In my eyes, we are clearly in a bubble, and the question becomes when it goes to burst, because it will burst at one point. But nobody can predict this, and so the question becomes, make it even sense to invest in the bubble and what to expect. And if you stick with me for a while, you know I'm a big believer in the theory of the intrinsic value of a business, of a stock. So my goal is to buy great businesses way under the intrinsic value with a big margin of safety. And if you look in my current portfolio, you will see that I was able to do this in the March crash. And so normally we have to wait for irrationalities, crashes like this, to buy way under the intrinsic value. And right now, with the FANG stocks, with the tech stocks overall, we have a situation that all of these businesses are overpriced. They are over the intrinsic value. As I said, you find a deeper analysis of all of these companies on my channel. There I explain also why I think they are overpriced, and I calculate the intrinsic value. And so because they are overpriced, they are not for me right now, even if all of them are great businesses, and I think the greatest businesses around right now. And on the example of Apple, I want to explain what can you expect if you invest in Apple, even at this high prices. In my other video about Apple, in my deeper analysis, I calculated an intrinsic value of Apple of $70 with a discount or expected rate, my expected rate or my expected return of 12%. And when you calculate that with 12%, you come to intrinsic value of $70. So, but what can you expect if you invest in Apple at a price of currently $110? And the answer to that is you can expect 7.8% return over the long term. And in this calculation, I calculated with the growth rate for the first 10 years or the next 10 years, 14%, and for the years 11 to 20 of 10%. And of course, nobody can predict the future. And so, of course, all of this calculation is just a guess. But I think growth over the next 20 years of double digits is optimistic. So this is an optimistic calculation. And so when you follow this calculation and you buy just right now at $110, you can expect a return of 7.8% over the next 20 years. And this, of course, calculated with the current EPS of the trailing 12 months of $3.30. 7.8%. That's not bad, but for me, not good enough. If I invest in a more or less high risk stock market, I even want a bigger return. And all of that is just a question of risk and reward, of course. And so my normally discount rate or expected return is 12%, at least for growth stocks like Apple or the other FANG stocks. For big players like, let's say, AT&T or Pfizer, which more come over the dividends, my expected return is 8%. And so I calculate my intrinsic value. And what you also can learn on this is that, of course, the intrinsic value depends a lot of your expected return. Because logically, if you want to have a higher return, you have to buy lower under the intrinsic value and vice versa. And so I come back to a quote of Warren Buffett. If you understood a business perfectly and the future of the business, you need very little in the way of a margin of safety. And if you remember, before I said I like a margin of safety and a big margin of safety. This margin of safety would be a price under the calculated intrinsic value, whatever it is. Since I'm not Warren Buffett and I'm not an investment genius, the margin of safety becomes very, very important to me because this really saves me to make big mistakes. Normally, I like to buy my businesses at least 20% under the intrinsic value. With the FANG stocks, I would make an exception and I would be very happy to buy into these FANG stocks at the intrinsic value. That's my point of view to that. And even if Warren Buffett said a margin of safety is not necessary if you understand everything, I'm smart enough to know nothing, to say it with the old Stoic Marcus Aurelius. And of course, even a return of 7.8% would be much, much more than the current US 10-year Treasury of a yield, which have a yield of 0.66, inflation of 2 or more percent, and maybe even rising inflation. This is at the end a negative return if you buy instead of Apple at this point, even with its high prices, if you would buy bonds of the US 10-year treasuries. And so, of course, Apple still, even at this high prices over the long term, can be a good trade. All of that just comes down to your expectations, and the question becomes, what do you want and what do you expect? Then just take my weekly look inside my portfolio. I had 2 buys yesterday when the market dipped immensely. And first of all, I added to my position of JP Morgan and I bought another 5 stocks for $95.13. And since also Imperial Oil dipped a lot in the last few days, I bought another 37 stocks at $13.24. And with that, the pie of my portfolio looks like that. Imperial Oil, just right here, come now to almost 3% of my portfolio. and JP Morgan is now at 3.88% of my portfolio, and I would like to have JP Morgan a little bit bigger, and if it drops more, then I will add even more because I think JP Morgan is the best bank in the US. And so lately, in the last week, my portfolio dipped as the whole market did. And right now, the performance of my portfolio since the 2nd of December 2019, when I started this North American portfolio, is a little bit under 20% compared to the S&P 500, which is at 5.81%. Right now, since the 2nd of December, as I said when I started the portfolio. And that's it for today. If you liked the video, give me a big thumbs up, subscribe to the channel and ring the notification bell to never miss another video. And then we will see you the next time with another video and another analysis of one of the stocks out of my watch list. See you then. Take care. Bye bye.